Hello my dear students, welcome back to our channel. Today we are going to study the basic accounting terms which every student must know. For class 11th accountancy, you must understand all the accounting terms which we are going to use in our further lectures and in our further studies. So this chapter is very important, not from the examination point of view but for the understanding of the subject's point of view. So let us dive into the world of accountancy and let us discover 21 basic accounting terms that we are going to discuss today. So let me start with you. Number one term is, what is a business transaction? See, you will hear a term transaction or business transaction. What does it mean? Transaction means any kind of transaction, any kind of activity you can say which is of financial character and which is related to our business. Let's take an example. For example, I have purchased a machine for my business. It is a business transaction and you can say it is a financial transaction. Similarly, example number 2, if I purchased raw material for my business, it is also a transaction. Any kind of activity that is related to my business and which involves money is a business transaction. Similarly, we can say I have given salaries to my employees. It is also a business transaction because my business is paying salary to my employees. So there are various examples which we can say are business transaction, like I have sold my goods and earned profit. It is also a business transaction. So any kind of activity which involves money, that is of financial character and relates to the business, is a business transaction. Simple. Now second term is, what is an account? You will hear this term many a times, account. What is an account? So you can link this word as a house, as a home. See, everyone has a home. So account is basically a home which is of a particular head. For example, like I have to record purchases. So all my purchases transaction will go under one head and that head is an account. Similarly, I will record all my sales and that sales will be recorded in one head and that head is an account. So account is a home in which one particular head of transactions are recorded or are placed. Like for an example, this is a demo of an account, how an account looks like. We can say it is a ledger. So this is an example. It is some kind of a tabular format with some lines in it. We will be studying it in later chapter number 8, but this is an account. So account is basically recording of transactions under one particular head. Now our next term is capital. You will hear the term capital. What is capital? Now suppose I am an proprietor or an owner. I start a business. So I'll invest some money or I'll invest some goods into my business. So every money or every good which I invest in the business is termed as capital. So capital is basically the amount invested into a business by a proprietor or an owner. So you can see here the proprietor is investing the money and that money invested into the business is known as capital. Capital may be in the form of monetary terms or in the form of asset. Like for example, if I invest rupee 1 lakh cash, that is also an asset. And if I invest a machine, say worth rupee 50,000 into the business, that is also a capital. So investing a machine or investing in the form of cash, both are treated as capital. So anything that has a monetary value invested into the business is known as capital. And capital is also known as, there are two other terms for it, you must remember. One is net worth and other is owner's equity. So capital is net worth or owner's equity. It has one mathematical formula also which we will be covering in our chapter number 5, accounting equation, but you must remember for as of now that capital is equal to asset minus liability. What is asset, what is liability, we will be discussing later. Now the next term is, what is drawings? Drawings is a very famous term in accounting because drawings altogether means something different. In layman terms, drawings is something you can relate with the craft or art, but that is not the case in accounting. In accounting, drawings means just the opposite of capital. Like you have invested money into the business. Now sometimes for any personal reason, if you withdraws the money back from the business for your personal use, that money withdrawn is known as drawings. So drawings is something which reduces your capital, because capital is the money invested into the business, and from that money if you withdrawing the money for any personal use, that is drawings. So drawings reduces your capital. So you can see the example, the owner is withdrawing money from the business or out of the business, and this is known as drawings. Sir, what is liabilities? You will hear this term liabilities many a times. Liabilities you can relate with the term burden. Means for business, anything which is a kind of a burden is known as liability. So liability is, in simple terms, amount payable to anyone outside. So liability means amount payable by the business. Let's take an example. Suppose business borrowed rupee 20 lakhs from Mr. Saxena. Now if I borrow rupee 20 lakh from Mr. Saxena, it is a burden for me because I have to repay now. So this 20 lakh rupee will be considered as liability. So any kind of burden is liability. Now liability is of two types. One is known as internal liability and other is known as external liability. What is internal liability? When I take money from the owner, this is the owner who gave the money to the business, which you earlier called as capital. So business says I have to return this money back to the owner. So it is also a liability, but this liability is towards the owner. That is why it is known as internal liability. But if I borrow the money from any other person, let's say if I borrow 20 lakh rupee from bank, now bank is not an owner. So I will consider this liability as external liability because bank is not the owner. So you can simply remember that liability towards the owner is internal liability and liability towards outsiders are external liability. So these are basic two types of liabilities. Furthermore, liabilities can also be classified, or external liabilities can further be classified into two types of liabilities. One is known as non-current liability and other is known as current liability. So what is non-current and what is current? There is a very simple difference between the two. If you borrow money or if your liability is for more than 12 months, means if you have to pay back the money for more than 12 months, then that is considered as non-current liability. For example, if you borrow the money for, let's say, 5 years and you have to repay after 5 years, then it is a non-current liability. But if you borrow money from a bank and you have to repay, let's say, after 6 months or after 7 months or after 3 months, means within 12 months, then that liability will be considered as current liability. So you can remember this in a way that non-current liability is kind of long-term liability which you have to pay after 12 months, and current liability is a kind of short-term liability which you have to pay within 12 months. So these are current and non-current liabilities. Now the next term is creditors. Who is a creditor? So there is a very basic term, creditor. It means if I purchase goods on credit. For example, if I purchase goods from a person, say Ramu, and I purchased these goods on credit, means I am saying to Ramu that I will pay your money after 3 months, and Ramu says okay. Then for next 3 months I will consider Ramu as creditor. So creditor is a person to whom you have to pay money after some time. And why you have to pay money? Because you have purchased goods from Ramu on credit. and generally creditors are considered as current liability because these are payable within 12 months. So Ramu creditor is our current liability. If I reverse this whole story, then there becomes the next term, that is debtor. Here, while pronunciation B is silent. So remember, B is silent here. So we pronounce it as debtor, D-E-T-O-R. But while writing, we will write as D-E-B-T-O-R. So who is a debtor? So if I reverse the whole story, let's assume that now I have sold goods to a person called Shamu. I have sold goods to a person called Shamu, and Shamu is saying that he will give money after 3 months. So that means I have sold goods to Shamu on credit. Now for the next 3 months, Shamu will be considered as debtor. I will call Shamu debtor. And generally these Shamu are considered as current assets. What are current assets? We will be studying very soon, but these are considered as current assets. So debtor are the persons to whom the amount is receivable within 12 months on account of credit sales, because you have sold the goods to Shamu on credit. Now let us dive into the one of the most important term, that is assets. What are assets? See, assets means simple, very simple, future economic benefits. Anything that gives the business any kind of benefit in future is considered as asset. So assets are the future economic benefits, that is the monetary benefits you will be getting in future. These are owned and controlled by the business. Like for an example, I have one machine, I have a camera, I have a projector, I have an AC, I have a furniture, I have the classroom in which students studies. So everything that I own that will give me a future economic benefit is known as asset. So we generally classified assets into 3 main categories. These are the examples which I have told you, like furniture, land, building. Further more examples are coming. But while talking about the classifications, there are 3 main classifications of asset. One is non-current asset, other is current asset. These 2 are main classifications, but third one is also there, which is not so much relevant right now, but you must for theoretical purpose also understand this asset, that is fictitious asset. Fictitious means imaginary. So it is a kind of, you can say, not so relevant asset, but we have to study for theory purpose. Imaginary means fictitious asset. Now what are non-current and what are current assets? So first let me tell you non-current assets. Non-current assets are those which you purchase for your business for long term, let's say for 5 years or 10 years, and you have no motive to sell them off. For example, I have purchased a machine and my motive is to keep that machine for next 5 years so that I can do the production, so I can produce more products. So this machinery will be considered as non-current assets. So I keep non-current assets for more than 12 months and they are not meant for sale. These non-current assets are also further classified in 2 categories. One is tangible assets that you can see and touch. Other is intangible assets that you cannot see and cannot touch. Now tangible assets examples are, let's say, building, machine, furniture, motor vehicle. All these assets are physical, have physical existence and you can see them, you can touch them. But there are intangible assets as well which you cannot see, which you cannot touch. Like for example, my business has a brand value which we can say goodwill. So goodwill is something which is an asset, but you cannot touch. You cannot touch my brand name, you cannot feel my brand name, that is my goodwill, and it has a value. It will give me future economic benefit. Similarly, let's say I have some rights, I have some patent rights or some copyrights. These will give me the future economic benefits, but you cannot touch it. You cannot see where are the rights. You can only see the certificate. You can only see the piece of paper, but you cannot touch physically. Like building you can touch, like furniture you can touch, but rights you cannot touch. So anything which cannot be seen or touched is intangible asset. Now let's move to current assets. Current assets are those which will be converted very easily into the cash within 12 months. Like, I have a stock, I have some you can say products, I will sell it off within 1 month or within 2 months. So all these kind of assets which will be converted into cash, which are meant for sale, which will be converted into cash within 12 months, you can say are current assets. So these are kind of short term assets which will be converted into cash. Now the third category is fictitious asset. Like I had said, these are kind of imaginary assets and not so relevant. So don't too much dive into the definition of fictitious asset. Let's keep it very simple. These are kind of imaginary assets. But what are they? They are basically some kind of losses, or you can say expenses, but which we have not written off in the year in which they are occurred. Let me give you a brief example about this. For example, I have spent 5 crore rupee on advertisement. Okay. Now what I will do, I will not treat it as a 5 crore rupee expense for this year. I will rather postpone it. Like, I will consider it 1 crore for this year, 1 crore next year, 1 crore next to next year, 1 crore next to next year, and 1 crore after 4 years. So when I defer my expense, it is also known as deferred revenue expenditure. There is a term which we will be covering later, deferred revenue expenditure. So these are fictitious asset. These only are fictitious asset. So it is a very not so relevant theory for your examination or for your terminology, but there exists a term fictitious asset, so you must know those. So these are the losses, these are kind of expenses which you are not writing down in the same year, but you are postponing them. In this example, I have spent 5 crore rupees on advertisement, but I am not showing it as 5 crore right now. I am showing it only 1 crore for this year, 1 crore next year, 1 crore next year, and so on. So I am deferring an expense. So this is the story of fictitious asset. So this is all about the assets. Now the next term is bills receivable. Very interesting story. What is bills receivable? It is an asset basically, but what is bills receivable? So let me take you back to the story of debtor. Remember debtor? Who is a debtor? No sir. Debtor is the person to whom I have sold goods, and he said I will pay after 3 months. Now Shamu says that he will pay the money after 3 months, but can you trust Shamu? No, we cannot trust someone that he says I will pay the money after 3 months. So what we will do, we will take a piece of paper, we will write that Mr. Shamu, you will pay our money after 3 months, and you will send this letter to the Shamu, and Shamu will sign it. Shamu will say, okay, I agree. Now this is a proof for you that Shamu will pay your money after 3 months. Now this piece of paper is an asset for you now. This piece of paper is known as bills receivable. So bills receivable is a very interesting story which involves debtor into it. So when you sell goods to a person on credit, the person is known as debtor. That is a separate story. And take that story a further little more ahead. When you signed a paper, when Shamu signed a paper and he agrees that he will give your money after 3 months, then that piece of paper is an asset for you, and that piece of paper is known as bills receivable. So bills receivable is a very interesting document, you can say, which we get it signed from the customer. So this story is given in this flow chart basically. Now similarly, let's dive into the next term, which is bills payable. So remember creditor. What's the story of creditor? You purchased goods from Ramu and you say to Ramu that I will pay your money after 3 months. Now the same story applies to Ramu as well. Now Ramu will take a piece of paper and Ramu will write on it that pay my money after 3 months, and now you will sign it. You will say, okay Ramu, we will pay you. Now this document, this piece of paper is a liability for you, because now you have signed on this paper and you decided to pay the money after 3 months. So now this piece of paper becomes a burden for you, becomes a liability for you, and this piece of paper, this document is known as bills payable. So bills payable story is related to creditor. So these are very interesting terms. These are interrelated terms. Link bills receivable with debtor, the previous one, and link bills payable with creditor. So these are very interesting terms. So this is Ramu and we are signing the document. So this document is bills payable. Now let's take you to the new term. It is a very simple term having a mathematical formula, trade receivable. So we have understood the term debtor and we have understood the term bills receivable. Now when you make the sum total of these two, so mathematically the sum total of these two is known as trade receivable. So it is a very basic mathematical formula. So trade receivable is total of debtors and bills receivable. Similarly, we can say trade payable. Trade payable is the sum total of creditors and bills payable. So it is also a mathematical formula term. Now the next term is very, very interesting. Before that, let's take a quick example test of our terms. Like debtors and bills receivable both will be considered as current assets, and creditors and bills payable both will be considered as current liability. Now let's move to a very important and very interesting terms. The next term is receipts. So receipts means if you receive the amount or you will receive an amount, both are considered as receipts. So receipts is amount received or receivable. Now receipts is generally considered or categorized into two forms. This is interesting and important. One is known as revenue receipt and other is known as capital receipt. What is revenue and what is capital? See, this is very important because I receive money, that is a very simple term, receipt, but I have to check the nature of it. If I sell, let's say, my goods, I have a stationery shop and I sell stationery and I receive money on daily basis, then this receiving money is a revenue receipt for me. It is of daily nature, it is of regular nature. So revenue receipt is kind of your main business activity and you are receiving it on daily basis. But when I receive money on a very irregular basis, or let's take an example, in my shop there is an old projector and due to some emergency I have to sell it off. Now I receive the money after selling my projector. Now selling projector is not my main business, it is not my regular activity. Once in a while I sell my projector and I receive money. Now that kind of receipt is capital receipt. So you must remember one keyword here, that the amount received in normal course of business is revenue receipt, but irregular nature kind of receipts are capital receipts. So there is an example for it as well, like you sell goods, which is your daily work, and you receive money. This is revenue receipt. But let's take an example, if you sell your land or some kind of machine, which is a very irregular thing because you don't sell your land regularly. Now when you sell your land and you receive money, it will be considered as capital receipt due to its nature. So focus on the nature. If it's a regular activity, it's revenue, and if it's an irregular activity, then it's capital. So this is revenue receipt and capital receipt. Similarly, the next term is just the opposite of receipt. It is expenditure. What is expenditure? Expenditure means any kind of amount that you spent or will spend. Simple. The amount spent or will be spent is expenditure, money gone. But here also we will categorize it into two main categories, or rather three main categories. Let us discuss what are they. So two main categories are, one is revenue expenditure and other is capital expenditure. Again same thing, you have to check the nature, that is very important. For example, I purchased some pen, I purchased some stationery, which is a very regular work for me. which is a very short term thing for me, its benefit will expire within 1 month or 2 months, then it is considered as revenue expenditure. But when I purchase a machine which is for a long term, which is once in a while I purchase a machine, in 10 years I purchase one machine, then it is considered as capital expenditure. So you must remember that revenue expenditure is something whose benefit gets consumed within 1 year. It's a very regular nature kind of expenses. But when you spend money on something whose benefit you are going to get for more than 1 month, for more than 1 year, let's say for 5 years, 3 years, 10 years, you purchase some fixed asset, you purchase some land, you purchased some machine, building, then that is considered as capital expenditure. So there is the nature involved in the expenditure as well. So these are the example. If I pay the salary to my employees, so it is a very regular kind of expense for me. I'll get the benefit for 1 month. But if I purchase a machine, I'll get the benefit for 5 years or more. So it will be considered as capital expenditure. So focus on the nature here. There is one other expenditure as well, which I will be discussing later, but I have already discussed, but I'll tell you what. But one term comes before that, that is expense. Now expense is nothing but the revenue expenditure only. So what you have understood in revenue expenditure, that is expense only. So but these two terms are generally given separately, but you can take them as one only. So revenue expenditure is expense only. So expense is given a definition that the cost incurred for generating revenue, means you are spending something to get the revenue or to get the income. So that is an expense. Its benefit gets expired within 1 year. That's it, expense. Now the expenditure portion, there the third category was deferred revenue expenditure. Again the same example of fictitious asset, but here the expenditure is known as deferred revenue expenditure because I have deferred it, I have postponed it for more than 1 year. Same example, I have spent 5 crore, but I will not show it as 5 crore today. What I will show it 1 crore today, 1 crore next year, 1 crore next year, 1 crore next year, and so on. So I am deferring a expenditure, that is why it is known as deferred revenue expenditure. So it is also a category, but as I said earlier, it is not so relevant, so just keep it very simple. Now the next term is income. It's very important. You must be knowing this term income. It's a very general term. So here income means your kind of profit, you can say, for the business perspective, and it has a formula, that is revenue minus expense. Revenue, you can say, means revenue receipts. Here revenue word means revenue receipts, minus expenses means you can say revenue expenditure. So revenue receipts is simply your regular incomes or regular money flows you are getting in, and revenue expenditure or expenses means your regular money flows that are going out. So money coming in minus money going out. So what you will earn, what is your income? Inflows minus outflows. So very simple formula for income. Just remember revenue minus expense. Now income sometimes, okay, let me take you to the next term first, then I will move back to the income because there are some terms related to income as well, but let me get first to this special term. This is prepaid expense. Prepaid, it means you are paying something but its benefit you will get in the next year. So this term is known as prepaid expense, and these are considered as current assets. It is very important thing. Now let me take an example. For example, I have paid rent, let's say 6,000, but this rent is not for this year. I have paid it in advance. This rent is for next year. So I will say this rent as prepaid expense. So very simple, prepaid expense means you are paying something but which relates to next year. Similarly, there is another term, that is outstanding expense. It means you have enjoyed the benefit in this year but still not paid it. Still it is outstanding. Outstanding means unpaid. So let's take an example. I have an employee, I have taken the benefit out of him, and I have not paid his salary for the month of March, let's say. So if I have not paid the salary for the month of March, it means salary is outstanding, means unpaid. So any kind of expense which is not yet paid is known as outstanding expense, and it is considered as current liability, that you must know. Now remember the income, yes sir, revenue minus expense. So here comes profit. Profit is also something which you can say is as same as income only. Sometimes they are also used interchangeably, because you can see the profit has the same formula, revenue minus expense. So profit means what you are earning from the normal course of business. But there is also another term just similar to profit, and that is, skip this part, this is not so relevant as of now. There are two types of profit, one is gross profit, one is net profit, that we will be covering in the later chapter. But there is a term which is very similar to profit, that is gain. Now see, difference between profit and gain is its nature of activity. Like suppose I sell my machine and gained out of it or earned a profit out of it. So selling a machine is not my main activity, or it is not my regular activity. So whenever I earn something out of a irregular activity, then it is considered as gain. So this is the difference between profit and gain. Just focus on the definition. Profit is earned from your normal course of business, what your day-to-day regular activities, and you are earning money. But when you earn money out of some irregular activities, like you sell your machine and get the profit, or you can say you earned a lottery income, then all kind of these incomes or profits are known as gain. So gain is from irregular activities. Now you understood the profit. Now reverse the term, that will become loss. So loss is something when your expenses are more and your receipts are less. So simple, loss means your outflows are more and inflows are less. So it is just the opposite of profit. And the next small term is stock or inventory. What is inventory or what is stock? If I have a business, all the goods which is ready for my production or which is ready to be sold is known as inventory or stock, that you can see in this example. Anything which is kept in my business, which is unsold, which is there in my factory, you can say, is considered as inventory or stock. It is generally of three types. One is raw material. Like if I have a manufacturing entity, I will have some raw materials with me. Raw materials are some inputs which will be used in production. Similarly, second type is work in progress. Work in progress is like my raw materials is converting into some finished goods, but while converting, before the process is complete, during the process they are termed as work in progress. And when the progress is complete and when the goods are completely made, then they will be termed as finished goods. So finished goods will be there with manufacturing entities as well as trading entities, both have finished goods. Like if I have a sari shop, I will have saris in my shop. These saris are finished goods. So stock can be in the form of raw material, or in the form of work in progress, or in the form of finished goods. All these are stock or inventory only. Now there is a term, next term, which you must have heard, I know, discount. But here I will tell you very interesting thing about discount, because discount, you know that discount is reduction in prices, very simple. You get some relaxation. But discount is of two types. This is more important for you. One is known as cash discount and other is known as trade discount. So there are two types of discount which you must know. One is trade discount and other is cash discount. So what is the difference between the two, trade and cash discount? So let me take an example. Both have separate definitions. When you purchase some goods in bulk, let's say one shirt is of 100 rupee, Then how much for 10 shirts? You will say, sir, 1000 rupees. But when I buy 10 shirts, I will say to the shopkeeper, please give me some discount because I am buying in bulk quantity. So discount when you are getting because of the bulk quantity is known as trade discount. So here the keyword is bulk quantity. And this trade discount is a very unique thing I am going to tell you. This trade discount is not recorded in the books. It's the quality of trade discount that when we will be discussing the next few chapters, I will give you more clarity on this, that trade discount is not recorded in the books. We just calculate it, but we do not record it. This is trade discount you get on purchasing bulk quantities. But what is cash discount? Now let me take an example. If I have to pay you 10,000 rupee after 3 months, next day I come up with an offer for you. I say, please give me 500 rupee discount and I will pay you your money now. I will give you your money today itself, but I will give you 9,500 only. Please give me 500 discount for early payment. And you agrees. Then this discount is cash discount. So cash discount basically you get when you pay early payment or timely payment. So it is for your time of the payment. So when you give early payment or timely payment, you get cash discount. And important thing here is cash discount is recorded in our books. We will record it just like any other transaction. But remember that trade discount is not recorded in the books like any other transaction. This we will be discussing later in the chapters, but just focus on the terms right now. So trade discount is you are getting the discount for bulk quantities, and cash discount you are getting the discount because of early or timely payment. So these are two types of discounts. There are some other terms as well. Let's quickly go through them. One is bad debts. You will hear this term a lot, especially in your class 12th. But what is bad debts? It is basically derived from debtor. Now who is a debtor? Debtor is a person from whom you will be receiving money. Now if out of the debtor one person says that I am not going to give your money back, now what will you say to him? That he is a bad person, he is a bad debtor. So bad debtor becomes bad debt. So bad debt means a debt which is not recoverable. In simple terms, it is a debtor who refuses to pay you the money. So you can say bad debt. Bad debt, yeah. So here is the story. Bad debt relates to the term debtor, you can say. There is another term, it is depreciation. I think this is the last term that we are going to study. What is depreciation? Depreciation is a technical term which is given generally associated to fixed assets. Like you have some machine, like you have a mobile phone and you use it for 1 year. So after using it for 1 year, obviously its value will go down. Now this reduction in the value of your fixed asset is known as depreciation. So depreciation is a very simple term. It means reduction in the value of your fixed asset, that is depreciation. So these are basically the terms which we have to study. So I hope you get to understand all the terms, you get to understand the keywords of all the terms, and please make sure to revise all the terms. You can refer your book, you can refer your school teacher notes or any other kind of material, but these all terms are very, very important for your further journey, for your accountancy knowledge. And please do like and share the videos if you really like the video, and keep sharing the videos and supporting our channel. Thank you so much for patiently listening to me, and I really enjoyed this session, and hoping the same for you as well. I'll meet you in the next video. Till then, take care. Bye bye. Goodbye. See you soon.